Imagine waking up every few months and receiving money in your account without selling your investments. Sounds too good to be true? Well, that's exactly how dividend investing works. In today's video, you'll discover why dividend stocks are one of the most popular investment strategies among long-term investors. We'll cover what dividend stocks are, why they're powerful, their biggest advantages, the risks you should know, and how beginners can start investing wisely. Let's dive in. What are dividend stocks? A dividend stock is a share of a company that regularly distributes part of its profits to shareholders. When you own these shares, you're not just hoping the stock price goes up. You may also receive regular cash payments. Many companies pay dividends every quarter, while some pay monthly or annually. This means your investment can generate income even if you don't sell your shares. Why do companies pay dividends? Companies pay dividends because they generate consistent profits and want to reward shareholders. Paying dividends also shows confidence in the company's financial strength. Businesses with reliable earnings often choose to return part of their profits instead of keeping all the cash. This is why many dividend-paying companies have established stable business models. Benefit 1. Passive income. One of the biggest reasons investors love dividend stocks is passive income. Instead of depending only on stock price appreciation, you receive regular cash payments. This income can be used for daily expenses, retirement, or reinvested to grow your portfolio. Imagine owning hundreds or thousands of shares that keep paying you year after year. That's the power of dividend investing. Benefit 2. The power of compounding. Albert Einstein reportedly called compound interest the eighth wonder of the world. Dividend investing allows you to benefit from this powerful concept. When you reinvest every dividend payment into buying more shares, those new shares begin earning dividends too. Over many years, this creates a snowball effect that can significantly increase your wealth. The earlier you start, the bigger the potential impact. Benefit 3. Lower volatility. Dividend-paying companies are often mature businesses with predictable earnings. Because of this, their stock prices tend to fluctuate less than high-growth or speculative stocks. While no investment is risk-free, dividend stocks may provide more stability during uncertain markets. This makes them attractive for conservative investors. Benefit 4. Protection during market crashes. Every investor experiences market downturns. The difference is that dividend investors may continue receiving income while waiting for the market to recover. Instead of panicking during temporary price declines, they focus on collecting dividends and staying invested. This mindset helps many investors avoid emotional decisions. Benefit 5. Dividend growth. The best dividend companies don't just pay dividends, they increase them. Many businesses raise their dividend every year as profits grow. That means your annual income can increase even if you never buy additional shares. Growing dividends help protect investors against inflation over time. Imagine you invest $10,000 in a stock that pays a 4% annual dividend. That means you could receive approximately $400 per year in dividend income. If you reinvest those dividends every year and the company keeps increasing its dividend, your portfolio can grow much faster over the long term. This is why patience is one of the greatest advantages in investing. Many beginners make one common mistake. They buy stocks simply because they have the highest dividend yield. But a very high yield can sometimes be a warning sign. If a company's stock price falls sharply, the dividend yield automatically appears higher. Always investigate why the yield is unusually high before investing. What should you check before buying? Before investing in any dividend stock, look at revenue growth, earnings growth, free cash flow, dividend payout ratio, debt level, dividend history. Strong businesses usually perform well in most of these areas. Who should invest in dividend stocks? Dividend investing is ideal for long-term investors, retirement planning, passive income seekers, beginners who want stable investments, investors who prefer lower risk than speculative growth stocks. Dividend investing isn't risk-free. Companies can reduce or eliminate dividends during financial difficulties. Stock prices can still decline. Some dividend stocks also grow more slowly than fast-growing technology companies. That's why diversification remains important. Dividend investing isn't about getting rich overnight. It's about building wealth slowly, consistently, and intelligently. By choosing high-quality companies, reinvesting your dividends, and staying invested for the long term, you give yourself the opportunity to benefit from both regular income and capital appreciation. Time is your greatest advantage. If you found this video valuable, don't forget to like, subscribe, and turn on the notification bell for more investing, dividend stock, and passive income content. Also, let us know in the comments which dividend stock is your favorite. Thank you so much for watching, and I'll see you in the next video.